High cash value life insurance is a fantastic tool to help you grow your business and can provide the necessary capital to get your business off the ground. In this video, we will see how 5 companies were saved because the owners borrowed from their whole life insurance policies to help pay company salaries, expand their business, or pay for marketing. 1929, J.C. Penney. The cash value of James Cash Penney's life insurance policies was utilized to cover the payroll and ongoing costs of his department store, J.C. Penney. He ran 34 businesses across the Rocky Mountain region by 1912. He relocated the business to Salt Lake City in 1913 and merged it with the J.C. Penney Company. There were 1,400 stores nationwide in 1929. The 1929 stock market crash and subsequent Great Depression significantly harmed the stores and Penney's wealth. His physical and mental health suffered as a result of the financial setbacks, but he was still able to borrow against his cash value life insurance policies to support the business's payroll and ongoing costs. Due to this, the business was able to survive and subsequently thrive. Penney held the position of corporate board chairman until 1946. He held the position of honorary chairman until his passing in 1971. 1939, Foster Farms. Foster Farms is known for its fresh, all-natural chicken products that are free of chemicals, preservatives, and sodium-increasing injections. Max and Verda Foster, a young couple, borrowed $1,000 against an insurance policy to launch Foster Farms in 1939. They invested in an 80-acre farm close to Modesto, California, where they started farming turkeys before moving on to chickens. The business outgrew the original farm by the 1960s and relocated its corporate offices to Livingston, a tiny town in the California Central Valley, where it is still located today. Ron Foster, a descendant of Max and Verda, currently serves as the company's CEO. Foster Farms presently employs over 10,001 people worldwide and has operations in California, Oregon, Washington, Colorado, Arkansas, and Alabama. 1955, Disneyland. In Los Angeles, in 1923, Walt Disney and his brother Roy founded the Walt Disney Studio. As the star of the first cartoon with synchronized sound, Disney's renowned creation Mickey Mouse made his debut in 1928 and immediately went viral. By the 1950s, Walt was fascinated with the idea of developing an amusement park where families could enjoy themselves. Walt opted to offer his funding after trying unsuccessfully to obtain formal financing to construct what would eventually become Disneyland. He borrowed money from his cash value life insurance as collateral for a significant portion of this. More than 3.5 million people visited Disneyland in its first year after it debuted in 1955. It quickly achieved great success. 1961, McDonald's. Richard and Maurice McDonald established the McDonald's Corporation in 1940 as a restaurant. In 1961, American businessman Raymond Albert Kroc bought the fast food chain McDonald's. During his first 8 years, Kroc did not get a salary. To deal with ongoing cash flow issues, Kroc borrowed money from 2 cash value life insurance plans as well as his bank to pay for the salaries of important staff. A portion of the funds was also utilized to develop an advertising campaign featuring Ronald McDonald, a new mascot. McDonald's became the most prosperous fast food company in the world thanks to Kroc's global development. 1980, The Pampered Chef. Doris Christopher, a home economist, founded The Pampered Chef in her suburban Chicago home in 1980 with the help of $3,000 she borrowed from a life insurance policy. Working with housewives all her life had convinced Christopher that women needed high-quality, time-saving gadgets to make cooking quick and simple. She created her own comprehensive, multi-level marketing business plan after studying the success of Tupperware's business strategy. She made a few basic inventory purchases with the life insurance money before leaving. By 2002, the business had expanded into a $700 million enterprise that Warren Buffett's Berkshire Hathaway Corporation purchased for $1.5 billion. What would you use your whole life insurance policy for? Please comment below. Why use your policy to fund your business ventures? The money you borrow from your policy is tax-free. The government does not tax money borrowed from your whole policy, and in fact, no one can take your policy from you, even in bankruptcy or divorce. You only have to pay 5% interest on the amount you borrow. Compare that to a credit card or bank loan. Credit cards charge up to 25%, and bank loans can be up to 14% or more. A 5% interest rate is small in comparison. You are making around 7% interest on the total amount in your policy even when you borrow, so you are still making money when paying 5% on a loan, especially if the total amount of your account is large and the amount you borrowed is small. This means the interest charged on 5% of $2,000 is around $100 and is considerably smaller than the interest paid on $100,000, which is $7,000. You don't have to pass any credit checks to borrow from your policy. The money you borrow from your life insurance policy is your money, so you can borrow from it anytime you want. Requesting a loan is easy and fast. You get your money usually within a week. The request process is simple and can be done online. You can also pay back the loan online as well. What strategies can you think of to grow your money even more? Please comment below. If you think this strategy is hot, we have more where this came from. Stay tuned for our next video.